Right, good morning to all and welcome back to Boutiques on Wednesdays. From the BCI team, we thank you for your continued support and we remain ever grateful. For those of us running building block portfolios for clients, there's been a lot of activity over the past 6 months on de-risking portfolios as central banks continue to tighten monetary policy. Some of the more recent conversations are about redeploying capital and when. Or are we staying in limbo for a bit longer? Who knows? The alternative is always to employ a good multi-asset fund or fund manager to make such decisions on behalf of you and your clients. The key then is to find top quality managers that demonstrated their skill in asset allocation, regional and sector asset allocation with good stock picking abilities. It's my privilege to host just such a manager this morning. Joining us now is Nick de Vos, portfolio manager at Centaur Asset Management, here to share their views on the market, how it played out over the past couple of months, and unpacking how they see that come together in the Centaur BCI Flexible Fund going forward. Good morning, Nick. So great to have you with us this morning, and we thank you for your time. Yeah, great. Perfect. That's it.
Okay. So, as Eugene mentioned, my name is Nick de Vos. I'm Centaur Asset Management. And today I'm going to be going through the multi-asset kind of flexible category, so really our flexible fund. And the kind of topic I'm going to be discussing is, when are we buying? It's a question that we've gotten quite often in client presentations. And there's a bit of a spoiler alert here. I'm not actually going to tell you when we're buying, simply because it's impossible to tell you exactly when. So the presentation is going to be going through a couple of the tools that we look at, a couple of the macro things busy going on in the world, how we put all that together, and currently how the fund's positioned and potentially how we're going to deploy that. So if we just move on to a quick business update. So the business was founded October 2000. So this month is the 22-year anniversary. So been through multiple bear markets like we're experiencing at the moment. Just over 6 billion in assets under management. It's retail only. We don't have any institutional money. And then something that you would have seen before by watching previous presentation, but it's really what we live by, the 3 principles: delivering investment excellence with outstanding service and the utmost of integrity. Then the flexible fund specifically has won multiple awards in the past, more recently the Raging Bull in 2021. And then we've also had a couple of staff changes, nothing major, but really just to improve the depth and to facilitate the growth of the business. And those 4 over there, I'm not going to go through all of them. So move on, just high level, just the past performance of the firm. So the Centaur equity strategy, just over 18% per annum versus the benchmark at 11%. This is all after fees. So the original investors that joined us back in October 2000 would be up just over 40 times on the original investment. And I'd like to say we don't take any of these returns for granted. We work hard every day to improve on them and to maintain them. So then just how we currently positioned. So I draw your attention to the cash and cash equivalents. This is now from the start of the year to date, how we've moved around the different kind of asset classes. And most importantly, that cash and cash equivalent was at 10%. That's up 15% to around 25% today. So that's probably the biggest change and most applicable to what I'll be discussing today. And then naturally, the equity content has reduced from 81% to 66%. So part of what's driven that is just the overall equity market coming down. So both locally, more so offshore. And we've actually received quite good consistent inflows over this period of time. And I'll touch a bit later on just how this asset allocation has progressed over time just to give you some context as to how big this cash and equivalence is versus history. So very high level, again, this is a slide that you would have seen if you've looked at our presentations before. It's a very important one. This is typically what we use to guide us in terms of SA, so specifically SA, equity content. So if you look at the pictures or the charts on the left-hand side, typically when we go overweight SA equity content, we look for a period where interest rates have been cut by 1.5% or more from a high point, or from the low, when interest rates rise from the low by more than 1.5%. That's typically a time to be underweight SA equity content. So currently we're in the tight phase. Rates are up 2.7%, 75% off the low. We'll probably continue seeing rates rise as the global central banks raise rates, and specifically the Fed. So conditions currently favor being underweight on SA equities. So very high level, rest of the presentation, I'm going to be discussing more US markets, specifically S&P 500. So this is just a chart showing what past bear market cycles have looked like. So if you look at the black line, that's the current market environment that we're in. So from December peak 31, the market's down S&P around 25%. But if you look at past bear markets, so the 1970s specifically, that's one that we identified when the Russia-Ukraine invasion happened. That's probably more similar to what we're facing today. So you had the Yom Kippur War back in the 1970s, but prior to that, you already had some level of inflation creeping into the market. It was exacerbated by the war when OPEC placed embargoes on Western countries, which shot the oil price up multiple times. And that's similar to what we're seeing today playing out in Europe. But this time around is playing out in the gas price, which is up multiple times in those countries. And then it took 1 year, 8 months from peak to bottom for that market to hit the bottom. And then in the 2000s, it took 2 years and 6 months. So I guess the point is, and this is partially what we're doing today, we think we are in a bear market. We're sitting on our hands because the market can take some time to bottom. Then just looking at the current Fed hiking cycle, very interesting. If you take the current cycle that we're in, we're seeing probably the fastest and the steepest rate hiking cycle that we've seen in recent history. So if you look at the black line, that 22 period, we're already 3% up from when the Fed started raising rates. And if you look at current market consensus, the expectation is still for another 1.5% plus rate hikes by Q1 next year. So that's that orange dot that I've placed on the line there. So clearly, one of the fastest and most aggressive Fed rate hiking cycles in history. And they're doing this to deal with inflation. It seems to becoming more sticky than initially anticipated. But I guess the point is, if you have we believe that if you do have a faster Fed rating hiking cycle, you might hit that bottom quicker. What also adds to that is that you're seeing a lot more information flowing quicker these days than what you used to in the past. I think 30, 40 years ago, if you were able to get your hands on a company's integrated report, you had a bit of an edge. That's just how slowly information used to move. And these days, Bloomberg headlines, as news come out, you see it. I mean, information on Twitter, the amount that you find on there is incredible, and how quickly it gets on there. So investors are able to make decisions a lot quicker. And you'll see how I touch on how the market typically looks ahead, especially economic data and earnings cycles. Let's move on. So just in terms of looking at the market relative to the economy, you'll often hear guys saying, the market doesn't follow the economy, or they don't pay too much attention to GDP, and that has some merit. So let's look at the June 1970 period that I've illustrated here. So that's when the market bottomed during this recession, but the actual economy only hit a low in November 1970. So the market bottomed 5 months prior to the economy actually bottoming. And at that point in time, the trailing PE of the market was 13 times. Now, it's also important to note how economic data gets disclosed, or GDP data. It's usually a lag. So what I mean by that, if we're sitting, in X year in January, the technical definition of a recession is 2 consecutive quarters of negative GDP growth. So in January, you could already, or January, February, you could already be in a recession, but you only hear about it in June. So it's a very backward-looking data point, and as I mentioned, the market looks ahead. So on average, it typically takes around what the market bottoms. So I'm excluding the 2002-2001 period, but the market bottoms 4 months before the economy or GDP data actually bottoms, which is also a backward-looking data point. And then on average, the trailing PE bottoms at around 10 times. Again, this is excluding the 2002-2001 period. Now, if you take where we're currently sitting, the market on a trailing basis, this is S&P, is sitting around 18 times. And on a forward basis, the market's around 16 times. Now, you can actually backward calculate the PE, and what's been interesting this time around is all we've really seen, you've had the US 10-year rate increasing, but you've had the equity market risk premium compressing. So the big question is where inflation actually settles. So the 5-year break even is currently around 2.5, 2.7. And if the equity market risk premium reverts to where it usually trades, there's potentially more downside. That's 16 times forward rating could compress maybe to a 13 times. And if inflation proves to be a bit more sticky, let's say it settles at 3.5%, 3.5%, then you could be looking at around 11 times. Then probably more important, for investors, what we look at, we don't spend awfully a lot of time looking at GDP or trying to forecast it, but earnings is what we look at. So if you look at past earnings cycles, so look at the green line over here, typically an earnings recession or decline in earnings, and this is also something that's very topical at the moment, you'll hear a lot of people talking about this, it takes 16 months from when earnings start declining for them to bottom. And we currently around 3 to 4 months into that. You'll see the yellow line here, the COVID period. It was a very quick recovery. Earnings bottomed after 4 months. Central banks pumped a lot of liquidity into the market, and things recovered quite quickly. So just as what I did with the economic data, if you compare the market to where the market bottoms to where earnings bottom, it typically takes, or the market typically bottoms around 8 months before you see a bottom in earnings. So if you're sitting around waiting for earnings to bottom, you could potentially miss it by 8 months. And then we've spoken about where the current trailing PE is. Okay, here I've included the early 2000 period. So that's around where the market bottoms, not the current, sorry, around 11 times. But what's also very interesting is you get guys talking about an earnings recession and that the PE is going to raise because of that. So if you look at where earnings typically have bottomed, the PE actually re-rates. So it goes to 19 times. So, very simple example on that. So let's say you buy a company at 100 Rand. So that's the share price. And it's currently generating 10 Rand in earnings. So that's a 10 PE. Then we go into an earnings recession. Maybe this is a company that particularly gets hard hit. So the share price declines from 100 Rand to 50 Rand. And your earnings decline from the 10 Rand to the 2 Rand. So even though your share price is off 50%, you've actually gone from a 10 PE to a 25 PE. So the business has re-rated. So it's very difficult, or it's not difficult, but inaccurate to look at what a PE multiple is doing during a bear market or recessionary conditions, because they tend to blow out. So sitting there looking at historical earnings or PEs and looking at a PE that's gone up and waiting for it to settle again, you're going to miss the boat. Okay, then this is also something very topical at the moment. Every time we see a bear market rally, you see headlines on CNBC popping up, everyone talking about the Fed that's going to pivot. You get the US 10-year slightly coming off. Maybe there's an expectation inflation will be slightly lower, and everyone starts talking about the Fed pivoting. So if you look at past bear markets and recessions, typically what happens when the Fed, and what I mean by Fed pivoting is that's when they do their first rate cut. So after their first rate cut, on average, it takes 14 months for the market to bottom. So seeing these bear market rallies in between, it's very tempting to get sucked into them. But if we lean off of history, it can still be some time before the market actually bottoms, even if you do get a Fed rate cut. So I guess the next question you might have is, so, why would the Fed pivot, or why would the Fed actually cut rates to begin with? So if we look at past cycles, and this is a very long history data set since 1956, and past cycles. So the blue line is where the Fed, what the Fed fund rate has been historically. And if you look at this period, 1970, you saw the Fed raising rates quite aggressively from around the 2.5% here, 1956, to around the 10% level. And eventually something broke. So this time in the 1970s, it was Penn Central. It was one of the biggest railroad companies in the US. I think it was probably one of the top 10 largest businesses in the US at that point in time. And what this caused was a bit of a credit market crisis, a bit of a liquidity crisis. Goldman Sachs almost fell over, and then the Fed pivoted. They had to stop raising rates, and they started cutting rates after that. Similarly, 1974, Franklin National was a large bank in the US. Fed were raising rates, something eventually broke, and they pivoted. They started cutting rates again. 1980 is quite an interesting one. It's actually worth it to read up on it, but it's a silver bubble. You had the Hunt brothers who essentially tried to corner the entire silver market, and they were buying silver on leverage. And at a point in time, they owned around a third of global silver, other than that was held by governments at that point in time. And what happened is their margin requirements were pushed up, and that caused the silver price to fall around 50% and caused kind of a widespread crisis and contagion in the rest of the commodity market. And again, Fed pivoted. The Mexican debt crisis, 1982, this is maybe something that I want to say it could potentially happen this time around. Not necessarily in EM. So typically what happens when you get this Fed rate hiking cycle, your rates go up, the dollar is very strong, similarly to what we're seeing today. And you get countries that are sitting with a lot of dollar debt on their balance sheets that get into a bit of trouble. Usually it's an EM. This time around, we have a lot of developed market debt, specifically in Europe, countries like Italy, Greece, sitting with very high leverage levels. But I mean, it doesn't necessarily need to happen. I'm just using it as an example. The next one that's probably quite interesting is the dot-com bubble in the 2000s. So here you didn't have this drastic Fed rate hiking cycle. It was just it was a bubble in terms of everything in tech being very expensive and things deflating. There wasn't actually a specific event that you could say, yeah, well, this company broke or that company broke. It was broad-based across the whole tech spectrum. And after that, the Fed pivoted and started cutting rates again. And then more recently, we'll all be aware of what happened in 2008 with the housing crisis, Lehman and AIG, and then the COVID bubble. Oh, not COVID bubble, sorry, the COVID pandemic. Okay, so I guess another thing we're looking out for is capitulation. So this is quite an interesting one. So what I've used here, the red line, is the VIX or option volatility. So typically what you get around times of crisis, maybe something breaks, market panics, and there's a lot of volatility in the market and almost capitulation or forced selling. So that forced selling can be driven by a number of things. Maybe a large asset manager's risk committee gets together and just decides, something's uninvestable, or they don't want to own it anymore, and they become forced sellers in the market at the wrong time when there's no liquidity or natural buyers for something. Or it could be when margin calls happen when there's too much leverage in the system. But if you look at the 2000 period, so there wasn't, like I mentioned earlier, there wasn't like a specific event which caused volatility to blow out. You just had that broad-based continuous selling and capitulation in the tech sector. 2008, you had the Lehman AIG that was maybe more event specific. You had volatility blowing out all the way to 80. And then COVID, we all know what happened, pandemic, everything locked down. So a sudden event and you had volatility spike up to around 65. So if you look at this chart, this doesn't mean it has to happen, but around the 40 number looks like when things start getting into distress, and it's something we look out for. We're sitting on quite a bit of cash at the moment, and any sign of capitulation in businesses that we want to own is typically a sign to get involved. There's been a lot of excesses that have been removed from the system, so you could say there's been some capitulation, and there has been. The non-profitable tech index has come all the way down. Excesses like Bitcoin, cryptocurrencies, NFTs, a lot of those things have come down. Then if we move on to just the next one. So I would say this is probably more important than everything I've discussed. So if we just take a step back, what I've mentioned are just things that we look at. They don't necessarily drive exactly what we do. So the kind of secret sauce, I guess, in all of these things is to take all these macro factors together and overlay them with the company specifics, and that way make a decision to when you're actually going to buy or not. So Topseg is a tool that you probably would have seen in past presentations that we do. Essentially, it's a kind of a ranking table. It's a tool that we use to identify opportunities. And this RR that I've put up here is specifically SA businesses. So in Feb 2020, the aggregate of SA businesses that we look at, we're reflecting a 3-year RR of around, call it 22, 23%. Then the COVID kind of crash happened, and we lowered earnings, we lowered multiples, or the inputs that goes into getting this number, and the RR settled at around 30%. Had we not changed earnings expectations or the multiple we applied, that RR would have probably shot up closer to around a 45% level. And then since then, you can see as the market has been running, the expected 3-year IRRs have been coming off. January 2022, that's when the market started coming off, and you've had this gradual increase in the expectation of what a 3-year IRR might be. Now, a point I want to make is that this isn't a kind of scientific exact rule. There's a lot of inputs we put into this. More recently, we've applied higher discount rates to businesses, or the multiple that we applied to them might be a little bit lower. So had we not changed that or reacted to the current environment that we in, the September 22 IRR would probably be closer maybe to a 25%. All the way on the right-hand side, it's just an orange line. I'm just using a theoretical example. So if the JSE, as an example, were to fall around 15%, then your IRR that you would expect over a 3-year period would increase to around a 25% level. But we don't necessarily look at this on an aggregate basis. We look stock specific. And typically when we look at a stock specific, we look for an IRR around a 25% level before we would potentially buy something. A 25% IRR might pull back to a certain level where we start thinking about potentially selling. So it's really a tool that guides us. It's not a cookie cutter approach. So like I mentioned earlier in the presentation, if you just look at historically how we've been positioned, so currently that 34% in the SA cash and cash equivalents, which is higher by historical standards. Currently that number is increasing. We are seeing good consistent inflows into the funds. And as SA market or global markets come off, that number will naturally increase. And it's quite a nice position to be in. What you don't want to see is as the market comes off, investors pulling out money, and then you almost you have to start trimming companies at the wrong time to build that cash position to be ready to buy at the right time. Then if we just look at the past performance in bear markets and how the flexible fund has done. So there's 4 periods that I've highlighted here. So I'll probably draw your attention more to period number 1, where we had a proper bear market, and period number 4, where we had that COVID crash. The periods number 2 and periods number 3 were market pullbacks, but they weren't that severe. So in 2008, outperformed the benchmark by around 15%, and period number 4 outperformed the benchmark by around 7%. That was coming out of that bear market. So just conclusion, before I conclude, maybe let's just wrap up kind of like high level what I showed you today. So it's important. Again, we only look at these specific indicators. It guides us. You know, it's a combination of 22 years of experience that the firm's been around and navigating multiple bear markets. You put that together with the internal tools that we have, both fundamental and quantitative tools, these kind of macro factors that we look at, and I've only touched on a couple. I mean, there's multiple ones that you can look at, and you pull all that together with your experience. And it's not an exact science of when you actually start the buying. There's an art element to it as well, and that's really what you build up over many of years with experience. So, in conclusion, Centaur has navigated multiple bear markets in the past, 22 years, navigated them successfully. It's a track record that's been built up by the founder, who's still actively involved in the business, Roger. And I think, maybe something guys don't always pay attention to, but he's built that track record. If you look at some of the non-boutique managers that have been around for many years, their teams change quite often, and those guys might not necessarily have built that track record or have had the experience of being through bear markets in the past. As I've shown, we've built up a large cash holding relative to what we typically hold in the funds, and we do continue to see inflows, and we'll combine all these various things with sound judgment and backed up by the tools that we have to create value in this volatility, and that some of our best returns have been coming out of bear markets. And that's my story.
Nick, thank you so much for that great presentation indeed. And as I mentioned to the audience in my introduction, if you're not sure about that de-risking or re-risking points or where to go in or out, think about a good flexible fund like Centaur to manage that on your behalf. Nick, just very quickly, a couple of questions. There's some questions from the audience as well. Just stay with the US. You had a very interesting slide on earnings per share and how it declines, 16 months after which we starts to bottom. But if we look at the US market, the US consumer at the moment, I mean, they're still very strong in spending like there's no tomorrow. They have several trillion US dollars in savings. So my question rather is, will we see earnings recession? Because that's probably one of the biggest concerns. We don't know when that pivot's going to be on inflation, but there's this going concern on earnings and earnings recession. But won't it be different this time given the strength of the US consumer?
So it's a very good question. I think if you look at history, so you're right, we haven't really seen much pressure of late. The banks have reported, the consumer seems like they're in good shape. Advertising's taking a bit of pressure, and what's quite interesting is you're finding companies in the US are pulling back more so than what consumers are. So they're kind of like anticipating that the consumer will pull back. And if you look at past cycles and that chart that I have up, it doesn't mean it has to happen, but history suggests that it eventually will, especially when the Fed is raising rates at the speed that they are. I mean, think about it this way. If you're running a business and you've had this long period of time where you haven't really lived with inflation, and you've got a consumer that for the past decade or two doesn't really know what inflation is, and I'm referring more to developed markets here. If you start trying to pass on inflation numbers, 15%. Europe, I mean, the numbers on PPIs, like Germany specifically, it's over 40%. If you start trying to pass on that inflation to a consumer that doesn't know it, it's very difficult. If you add any leverage to that, and this is maybe an important point I didn't touch on. So rates are coming off a very low point. You know, like in simple example, let's say you're coming from interest rates or your debt, you're funding it at 2%. If it goes to 4%, your cost of funding doubles, and that's going to hit your bottom line. In SA, you know, if rates go or your funding goes from 6% to 8%, it's a 30% increase. And it's a bigger number, but the quantum is smaller, and inevitably that has to hit your bottom line. So it's a combination of trying to pass these prices on to consumers and how that filters through your balance sheet with higher costs of funding. So it doesn't have to happen, but history suggests it will.
Thanks, Nick. And let's stay on the US. A very good question from Christian, one of the audience members. What is your view on the shift in dynamics around energy production versus the 70s, where the US has moved from the largest importer and consumer of energy to currently being a net exporter of energy? Could this not generate a significant energy dividend for the US rather than being a headwind?
Yeah, that's a very good point. You know, I think it can be. So what happened in the 70s, and you know, this is just what I've read, but I guess what eventually helped to bring it down, so it was the Fed raising rates, and you had this kind of like double bottoms. You had rates rising, cut, and then inflation reared its head again, and then you had this cut, and there wasn't any investment into physical assets. So the US went on this drive to invest in refineries and energy. So I guess that's partially what brought it under control. But yeah, this time around, they're an energy exporter. I guess it makes them a little bit less dependent on it. Europe, not so. Europe's potentially in a lot more trouble. And yeah, look, energy is just one thing. It's not the be-all, end-all. What we're seeing at the moment is inflation sticking in other areas besides energy. So energy is maybe something that can be cyclical, but if you start looking at more sticky parts of inflation, things are starting to sick, and it's a bit of let's call it like a psychological thing. You know, once inflation's there, then people start thinking it will continue coming, and you know, that's how these kind of things become sticky. You know, when we talk about it, it's fine, but when the man on the street starts talking about it, that's when it becomes a bit more of a problem.
Yeah, and I mean, I tend to agree with you. Europe and UK especially tends to be in a bit of a mess at the moment, and you know, I think they're stepping into hot water over the next couple of months with energy. But let's talk about markets that are counter-cyclical, something like, for example, China. You know, China are still funding, they're still expanding, but investors, I mean, are very spooked with policy clampdown, especially in the tech sector over the past couple of years. More recently, Xi Jinping's re-election for the next 5 years. Interesting how those systems work. But what is your view on China? I mean, is that an investable place, or is it something you totally avoid at the moment?
Yeah, so look, it's a discussion that we're having internally. So, you know, if you look at it very high level, so first question, is it investable or not? You know, I don't think we've, you know, entirely answered that question yet, but there's a lot of things that are going on. So the one question is, do you invest in a business that is directly in China? So where you're going and buying a business in China, you know, that I'd say we'd probably more avoid than anything else. So we don't currently own any Naspers or Prosus. So that would be a similar example where they've got their direct stake in Tencent. But there's various reasons, and I can go through Naspers and Prosus, you know, exactly why we haven't owned it. So that's the one point. But I think you can invest in businesses who operate in China. So if you invest in a business listed in another country that has operations or generating profits in China, so like one that we own, Aspen, who's busy expanding into China, I think there's a lot less risk in that. Now, the Chinese have been on this crusade of opening up to the rest of the world. And again, this is all very difficult to give definitive answers because we are at an information deficit, sitting here versus sitting in China. But China has been opening up to the rest of the world for many decades, and I think it's quite difficult to see them change tact on that. Why would they go and do something intentionally to close themselves off from the rest of the world? They've built an economy that's dependent on exports. So, I just don't see how they do anything drastic. Why we haven't owned Naspers or Prosus? Well, first we didn't think Tencent. We did own it. We got out. There was this regulatory news. We rode some of it a bit down, and we eventually completely got out a couple of months ago. But Tencent itself, we didn't think was offering any particular value. The question is now, do Chinese companies attract a permanent discount similar to what we saw in Russia prior to this war? They might never re-rate to where they used to be. I think that's a possibility and something people need to think about. But is it completely uninvestable? Probably not, but we're not buying anything directly in China. And at the moment, Naspers Prosus, we're sitting on our hands. We haven't been buying. That's maybe to give you if you want an exact answer, we haven't been buying Naspers and Prosus, but it doesn't mean we won't. At the Naspers Prosus level, things have actually been improving to some extent.
Yeah, thanks for that, Nick. Let's talk a little bit about that secret sauce slide you had on, where you spoke about the internal rate of return of companies over the next 3 years, in excess of 15% and higher. And help me, correct me here, but my understanding of your fund, and we've seen this in the past, where there are very short periods where you go through stages of a little bit underperformance. But in my mind, it's almost like the repositioning, trying to find those companies that will give you that proper internal rate of return of 15% plus, repositioning the fund. And you can actually see those returns coming through over any kind of 2 or 3 year cycle of the Centaur BCI flexible fund. But talk us a little bit through your stock selection process. Is that more or less where you are now in that repositioning to make sure that you've got companies that can give clients these returns? And maybe as an example of 1 or 2 of those companies that you are looking at the moment and why.
Yeah, so very high level. So currently we have underperformed a bit year to date. That's maybe why we're seeing, maybe guys are seeing the same thing you see. That's why we're getting the inflows, because guys expect us to outperform like we have in the past coming out of this. So ideally, you don't want to ever underperform, but naturally you are. I mean, you're taking active bets, it's going to happen. So currently what we're doing, we reassessed the entire portfolio. You would have seen a long duration business that we've spoken about in the past, Spotify. We don't own it anymore. We sold it at quite good levels. Some of the businesses that have contributed to the recent underperformance, we still hold. We haven't sold them. And they are more, let's split offshore and SA. So offshore, it's higher, let's call it beta, cyclical businesses, but they do fall into a value camp. So when we saw the inflation picking up, our expectation was for value to hold up a bit better. I think we maybe underestimated the cyclicality of these businesses. But, usually a cyclical business on the way up, it outperforms, just like it fell on the way down. But at the moment, what we're seeing is a lot of these cyclical or more value businesses that we own have kind of found a level. Especially over the past month or two, you'll see our performance is slightly starting to creep back again. So those, we're eyeing to probably buy more. We're sitting on a lot of cash. We're eyeing to buy, we've got a whole list of businesses offshore, businesses that historically have been quite expensive, that we might not have paid up for in the past, that we think are going to get down to attractive levels. So probably more high quality businesses. Example of that, we have a very small stake that we've bought in Kering. That's one that we'll add to, as it comes off. We've done, a bit of, let's call it quality switches or themes that we're backing. PGMs we're completely out of. We've bought into the energy theme. Even though energy is coming off, we think it's a theme that's going to play out for many years to come. We'll add to those cyclical businesses. SA, 2 that have added a bit to the underperformance, and one's so specifically Aspen. So Aspen, at this, it was a big position in the fund, it still is, at this big run up from 130 to 280. At 250, we trimmed a bit. So hindsight, maybe we should have trimmed more. But it's come off all the way back down to, I think it's around 150 at the moment. But that's one that we're eyeing to buy more of. We're still very comfortable with management. We still think that they're exceptional value creators. There's a lot of levers that they can pull. So it's really about, we're sitting on our hands. We've got positions we want. We've mostly gotten rid of ones we don't want to own. And we're eyeing to buy and potentially add new, maybe higher quality positions, specifically on the offshore side.
Yeah. And I mean, if we look at your past performance strategy and that secret source process really works for Centaur, remain invested in the fund, you continue to do well. We're very much out of time. Very quick question, and that speaks to your current asset allocation, a little bit lighter on equities, more cash. What's your views on SA bonds? Do you hold any bonds? Are you buying back into bonds, or is it just pure cash?
Yeah, so we've got some bonds in the flexible fund, but they're more shorter dated. So I think like average duration, 5, 6. But I guess the question would be, if the SA 10-year is sitting at, call it 11% or wherever it is, it's offering good value. You're getting a real yield 3-4%, which is very attractive relative to global. SA is not sitting with a lot of dollar debt. We're very fortunate not to have that. Remember the EM story I spoke about earlier. We'd be under a lot of pressure if that potentially was the case. So, it's probably not a bad bet, but I would say what's probably more exciting is what equities are going to do over the next couple of years.
Yes.
So we're holding 66% now, equity content, but I wouldn't be surprised if that number, if we turn positive, that number goes closer to like an 85.
Exactly. Sounds very promising. And like I said, we just don't know exactly when that will be, and I can't hold you to it. A very, very last question, and speaks to global allocation. You mentioned 1 or 2 companies that you're looking at in the global space that offers, very, very good valuations, decent returns for investors. But given the extraordinarily strong position of the dollar currently, does that impact on when you up your global exposure, or do you just look through that and say, but there's good value, we're going to buy now?
Yeah. So if you looked at that asset allocation slide that we have, I guess one area where we need to do something, and we'll get the opportunity with these bear market rallies, because the rand typically strengthens with that. We need to take more cash offshore into dollars and then deploy it. I don't think in the short term, focusing on exactly what the dollar is going to do. I think the potential for these companies to perform over a 3-5 year period, what the dollar does over a 6-month, 1 year period, will kind of come out in the wash. But it is at a high level, but if you're taking a bit of a longer term view on that, it kind of sorts itself out.
I think that answers that to the point. Nick, again, thank you so much for your time this morning, and thank you for the great work being done by you and Roger and the team. Always great to have you on our sessions. To our audience out there, quick reminder, next week, Wednesday, 2nd of November, our 3rd last session for the year. Can you believe it? Almost coming to a close. We've got Ritwa on global property again. We hope to see you all there. You know how the story works on our side. If you want more information on the Centaur BCI Flexible Fund, or chat to the team around what they do in the fund, you're more than welcome to get hold of us, and we can put you in touch with either Nick and Roger, and we can take it from there. Thank you so much for joining. Thank you for your time. Nick, again, from our side, thank you to the BCI team. Always great work you do out there. Stay safe, and we look forward to see you again next week, Wednesday.
Thanks so much.